Hello everyone, and welcome to the first in a series of Mayor Brown webinars on ESG matters, looking particularly at ESG disclosure requirements. My name is Tim Baines. I'm counsel in the environment team of Mayor Brown's London office, and I'm actively involved with the firm's international and multidisciplinary ESG practice. Today, we're going to hear from Christina Thomas, who has recently joined Mayor Brown from the US Securities and Exchange Commission. In her most recent role at the SEC, Christina was counsel to Commissioner Elad Roisman. Christina was the Commissioner's lead counsel on all matters related to public companies and international affairs. I know she dealt with ESG issues often in her role, especially related to public company disclosure, when advising on SEC rulemakings or working with foreign regulators on potential avenues for cross-border harmonization of rules and regulations. Today, Christina is going to speak about the SEC's current ESG regulations and what she expects to change in the near future with a new president in the US and a new chairman at the SEC.
Thank you very much, Tim. I am excited to be able to kick off this series. In my time at the SEC, I witnessed ESG investing increase, along with calls for additional ESG disclosure from public companies and asset managers. We are still in the early days of the Biden administration, and the president's nominee for SEC chairman has yet to take office. But I think already it is safe to say that the next SEC will take a different approach to ESG disclosure regulation than what we have seen in the past. Let's start with an overview of the SEC's current rules and regulations applicable to ESG disclosure, and then move on to discuss recent policy shifts at the SEC, as well as attitudes expressed by President Biden and his nominee for chairman, Gary Gensler, that will give us a sense of where things may be headed. Much attention has been paid to the ESG disclosures, or as some would characterize it, the lack thereof, that public companies provide to investors. Public companies in the US are not currently subject to a standardized ESG reporting framework. To the contrary, much of the SEC's disclosure regime is principles-based and encourages the disclosure of tailored, company-specific information. I will note that there are certain prescriptive disclosure requirements for companies in areas where there is consensus that the disclosure is material to investors and they would benefit from comparability across companies, as well as consistency in information reported each year. Think of US GAAP financial reporting. Generally, though, companies are subject to a materiality standard that was established by the US Supreme Court. Information about the company is material if there is a substantial likelihood that a reasonable investor would consider it important in deciding how to invest or vote. To the extent ESG information is material to a particular company, that company must disclose it. That is the law. If the next SEC wishes to make any changes to a company's reporting requirements, a majority of the commission must vote to approve the rules. Now, over the years, certain ESG disclosure requirements have made their way into the SEC rules. For instance, a company must disclose whether members of its board of directors consider diversity in identifying nominees for director, as well as information about any applicable policy. And most recently, recognizing that for many US public companies, human capital resources are material to how they run their business, the SEC adopted rules that would require human capital management disclosure to the extent it is material. I would also like to give an example of SEC required ESG disclosure that is a bit of an outlier. The SEC recently adopted rules requiring public companies engaged in the commercial development of oil, natural gas, or minerals to disclose payments to certain foreign and domestic governmental entities. The majority of the commission that voted to implement this rule made very clear that they were doing so only because they were instructed by Congress, and that they did not view the disclosure to be material to investors. I think it is fair to say that the view of the SEC majority in the last administration was that while certain ESG disclosures may be material to a particular company, this is an ever-changing landscape, and the current principles-based system will allow it to evolve while still requiring material disclosure from companies. In other words, they took the view that there is not enough comparability across companies or consistency in exactly which ESG disclosures may be material at a given point in time to justify codifying standardized disclosures. That said, there is an expectation and a legal requirement that companies disclose material ESG information. Recently, any revisions to the disclosure rules made by that majority were met with strong opposition from the minority commissioners, who have called for more ESG disclosure from public companies, particularly with respect to climate change, diversity, and human capital. In addition, two of the SEC's advisory committees, the Investor Advisory Committee and the Asset Management Advisory Committee, have both taken up the topic of public company ESG disclosure. And the conversation has focused on adopting a standardized disclosure framework. Now that sums up the current status of SEC rules and regulations on ESG pertaining to public companies.
Christina, but many US public companies already provide sustainability reports or corporate social responsibility reports. Why do that if not required by the SEC, or why not put that information in your SEC filing?
That's a great question, Tim. And I think a conversation on ESG disclosure would not be complete without discussing the impact of private ordering. By private ordering, I am referring to companies providing ESG disclosure in response to requests from their investors, not pursuant to government regulations. Up until now, private ordering has played a large role in this space, prompting ESG disclosure inside and outside of SEC filings. One reason why public companies may be reluctant to put non-material disclosure in their SEC filings is because of the liability that attaches once they do. US companies face greater litigation risk than companies listed in almost every other jurisdiction. They are subject to enforcement by the SEC and other federal agencies, as well as state authorities for information in their SEC filings. In addition, the law provides a private right of action. Investors can and frequently do sue companies for information that they do or do not disclose in their filings. Because of this litigation risk, public companies have to consider how best to be responsive to their investors if management does not deem the requested information to be material, such that it would be required in an SEC filing. And that sometimes results in a company publishing a sustainability or corporate social responsibility report.
Can we change tack for a moment and consider investment product disclosure? Christina, as you know, the EU published its Sustainable Finance Action Plan nearly 3 years ago. That included a commitment to tighten up regulation in the ESG investment space. And over the last few months in particular, investment firms have been grappling with how to comply with the EU's regulation on sustainability-related disclosures in the financial services sector, known as SFDR. Does the SEC currently have any rules in this space?
Yes, SEC ESG disclosure in the investment product space has received a fair amount of attention in the US as well. According to SEC data, the number of funds whose names include the terms ESG, clean, environmental, impact, responsible, social, or sustainable has increased by over 300% between 2007 and 2019. Now, you've likely heard of the term greenwashing, which refers to advertising or marketing that suggests a product is environmentally friendly when really it is not. For instance, a firm may sell a so-called ESG fund to investors, but when you look into what is in the fund portfolio, it includes a coal company. Now, maybe the reasoning is that the coal company, though it's bad for the environment, they're doing everything right in the corporate governance department. But in terms of applicable regulations, the SEC currently requires that all material information about a fund be disclosed to investors and potential investors. The SEC also has a rule that prohibits funds from using materially deceptive or misleading names. This rule is commonly referred to as the names rule. The SEC put out a request for comment last year to ask the public whether the rule continues to accomplish its purpose to protect investors and help ensure they are not misled by a fund's name. No amendments to the current rule were subsequently proposed, but the next commission does have a fair amount of feedback available from market participants if they decide to propose revisions to the rule.
It'll be interesting to see how this area develops in the UK. We thought until late last year that the UK would implement SFDR, but that turns out not to be the case, even though a number of UK entities will be caught by it. I guess it's watch this space for now in the UK too. What do you think we can expect from the SEC in this arena under the Biden administration?
First, I think it might be helpful, especially for those viewing this from outside the US, if I quickly walk through how the SEC is structured as an agency. The SEC is a 5-member commission with a fair amount of duties delegated to the approximately 4,500 staffers. However, for bigger actions, such as bringing an enforcement action or adopting new rules, the commission itself must vote, and a majority vote is required for approval. At any given time, there cannot be more than 3 members of the commission who are affiliated with the same political party. The chairman, who sets the agenda for the agency, is selected by the sitting president, and the other 4 members are usually split as 2 Republicans and 2 Democrats, each with a 5-year term. Since the administration just changed, the makeup of the commission will change as well. President Biden nominated Gary Gensler to lead the commission as chairman. Mr. Gensler just last week had his hearing in front of the US Senate and is awaiting confirmation. Once he is confirmed and sworn in, the Democratic commissioners who were in the minority in the last administration will then be in the majority, and the Republican commissioners who were in the majority in the last administration will then be in the minority. In the meantime, President Biden has named Democratic Commissioner Allison Herron-Lee to serve as acting chair of the SEC. President Biden himself has already spoken on the topic of ESG, stating that he will require public companies to disclose climate risks and the greenhouse gas emissions in their operations and supply chains. Based on these remarks, it will not be surprising if Mr. Gensler makes public company ESG disclosure a priority.
So the UK government announced late last year that it wanted disclosures aligned with the Task Force on Climate-Related Financial Disclosures across the UK economy by 2023. Listed companies in the UK will be required to include a statement in their annual financial report, which sets out whether their disclosures are consistent with TCFD recommendations and to explain if they haven't done so. There have been similar moves to require TCFD-aligned disclosures elsewhere in the world, as you know. Is the SEC heading in that direction too?
There has been much focus in the US on adopting a standardized disclosure framework that will allow investors and others to compare companies to one another based on their climate and other ESG disclosure. Mr. Gensler stated during his hearing last week that in 2021, there are tens of trillions of dollars invested in assets that are looking for more information about climate risk. And I think then the SEC has a role to play to help bring some consistency and comparability to those guidelines. If the SEC decides to adopt a standardized framework, it will have to determine whether it makes the most sense to start from scratch and create something new, or to adopt an already existing voluntary ESG framework promulgated by a third party. And many such frameworks already exist. There has been an increasing convergence around 2 such frameworks by investors. The first, you mentioned, the Task Force on Climate-Related Financial Disclosures, or TCFD, and the other being the Sustainability Accounting Standards Board, or SASB standards. For instance, in his annual letter to CEOs, Larry Fink stated that BlackRock, the world's largest asset manager, expects the companies it invests in to make progress towards SASB and TCFD-aligned reporting, or else BlackRock will be increasingly disposed to vote against management and board of directors. Now, while it may seem like the easiest thing for the SEC to do would be to adopt the TCFD and the SASB disclosure frameworks wholesale, there is some difficulty in that. Namely, the SEC does not oversee or have any relationship with those third-party standard setters. Now compare this to the Financial Accounting Standards Board, the FASB, which is the standard setter for US GAAP accounting. Would the SEC trust these standard setters on a going forward basis to review and update their standards appropriately? Or would the SEC be more comfortable adopting standards over which it has unilateral control? I would not be surprised if the SEC is already thinking through these questions, and I would expect serious discussions to begin once the new chairman is sworn in.
You mentioned previously that a majority of the Commission is needed to approve any new rules. I gather it would be difficult to adopt anything currently with only 4 commissioners. How quickly could things move once the new chairman takes office? Is there anything that could happen in the meantime?
Yes, so the rulemaking process does take a long time, usually a couple of years from start to finish. The Commission has to propose a new rule which requires a majority vote. They then have to allow the public to provide feedback. After that, the staff has to respond to that feedback and draft a rule for the Commission to then consider for adoption, which requires another vote. However, in the meantime, the acting chair has the ability to make changes at the staff level, and the chair will have that same ability when he begins. But acting chair Lee has already taken several steps to prioritize climate change and ESG while she is in charge of the SEC. For instance, she hired a senior policy advisor for climate and ESG to oversee and coordinate the agency's efforts related to climate risk and other ESG developments. Subsequently, she has made several announcements related to an enhanced focus on ESG. One announcement related to the Division of Corporation Finance's increasing scrutiny of climate change disclosure provided by public companies. Another related to the creation of a climate and ESG task force in the Division of Enforcement. And the press release announcing the Division of Examinations 2021 examination priorities promised an enhanced focus on climate and ESG related risks in broker-dealer and investment advisor examinations. So a lot of SEC registrants are paying attention to these announcements and wondering how best to comply with any new requirements. So I think it's important to mention that these announcements do not create any new obligations. Instead, these statements should be viewed as a reminder to registrants that existing statutes and regulations are applicable when it comes to ESG. For example, to the extent that ESG information, like any other information, is material to investors, it must be disclosed. This, of course, means that securities law violations can occur in the ESG space. And if the new enforcement task force recommends action against market participants, those alleged to have broken the law will need to carefully consider whether to settle with the SEC or litigate and let the courts decide whether a violation has occurred. Again, although no rules have changed yet, these announcements and remarks from President Biden, Gary Gensler, and the acting SEC chair and staff all signal that Commission action can be expected in the near future. So, in sum, the SEC and the prior administration focused on company-specific disclosure requirements, providing companies with the flexibility to decide what information investors should know. The next administration's SEC is not expected to provide the same deference and is more likely to focus attention on requiring uniform, standardized disclosure from all public companies. There have been calls for standardized disclosure from asset managers selling ESG investment products, but they have not been nearly as loud. So I think it remains to be seen whether the same attention to consistent and comparable disclosure will be paid to ESG investment products. But what is certain is that the SEC is currently taking a wholesale approach in examining how to integrate climate and ESG considerations into the agency's regulatory framework.
Thank you so much for your insights today, Christina. That was fascinating. And just to let our audience know, please watch out for invitations to future webinars on ESG. We're planning one shortly on the EU's ESG legislative regime. Thanks everyone for joining us.
Thank you.